Ever pondered how companies ensure their liabilities are accurate and complete? It's a big question, right? Well, allow me to demystify it for you. This process is known as auditing creditors, or in simpler terms, verifying the accounts payable. An audit of creditors is a methodical process of confirming the accuracy and completeness of the liabilities that a company owes to its suppliers or service providers. It's not just about making sure the numbers add up. It's also about ensuring that every transaction that took place during the accounting period is recorded in the accounts payable ledger. It's about verifying that the balances reported on the balance sheet reflect the actual amounts and terms of the obligations. Additionally, it's about establishing that the company has the legal responsibility to pay the creditors as of the reporting date. And finally, it's about making sure the accounts payable are properly classified and disclosed in the financial statements. Quite a task, isn't it? To achieve these objectives, auditors perform various audit procedures on the accounts payable. They start by obtaining an aged listing of accounts payable and reconciling it to the general ledger. Think of it as a double-checking process. They then select a sample of accounts payable balances and confirm them with the suppliers. This is to ensure that the recorded balances match with the supplier's records. They don't stop there. Auditors also examine supporting documents such as invoices, purchase orders, and receiving reports for the selected balances. This is to ensure that the recorded transactions are valid and authorized. Testing the cutoff of accounts payable transactions is another critical procedure. This involves comparing the dates of invoices and goods received notes to determine whether the transactions are recorded in the correct accounting period. And of course, there's the review of subsequent payments and credit notes. This helps identify any unrecorded liabilities or overpayments. Finally, auditors evaluate the adequacy of the accounts payable disclosure in the notes to the financial statements. This is to ensure that the accounts payable are presented and disclosed in accordance with the applicable financial reporting framework. These are some of the common audit procedures for accounts payable. But remember, these procedures may vary depending on the nature and complexity of the business, the level of risk, and the audit assertions. So, to sum it all up, an audit of creditors involves a systematic process of verifying the accuracy and completeness of a company's liabilities. This is achieved through various audit procedures, including reconciling accounts payable to the general ledger, confirming balances with suppliers, examining supporting documents, testing transaction cutoffs, reviewing subsequent payments, and evaluating accounts payable disclosures. All these procedures are designed to ensure that the company's financial statements provide a true and fair view of its financial position. Quite a journey, isn't it? And all in a day's work for an auditor.